Okay, what I'm going to do today is I'm going to follow on from the video I did on YouTube, the complete guide to position sizing. I will just show you how to find that. And we're going to talk about R multiples. So if you go onto the Trading Bases YouTube, just go to the risk management and view the full list, and it's the top one there, the complete guide to understanding position sizing. And that covers all this exciting stuff when we're position sizing for a stock, fixed fractional growth. So, if your account is 100,000 and you risk 1% per trade, 1R risk is going to be £1,000 per trade, isn't it? And, as the account grows, the risk in pounds grows, though it remains 1% of account. All this exciting stuff. And when position sizing for a stock, I'm going to drop this in the website when I've finished it. I've got a little bit more work to do, just for the members to download. Bankruptcy risk, profit warning, heat, all these exciting things we have to deal with when we buy stocks. So I'm going to follow on from this, and we're going to talk about R multiples now. So I've got the Trading Bases R multiple calculator here. And anyone who's listened to me go on about this for some time will be able to, recite this off by heart. How, money is made in the market by risking one to make two or more, and being right about half of the time. That's all you've got to do. Risk one to make two or more, and you've got to be right around half of the time. If you want to go in depth on that, just go to the website, tutorials, public or member tutorials, and just look at the first tutorial on there, the simple guide to risk management. So, fixed fractional growth, we're talking R. 1R, it's a consistent thing. You keep your R consistent, and for simplicity's case, we're going to say 1% of account. So risk 1R, and we're going to put in the reward. So risk 1, and if we go on here, reward is 2. If we risk 1 and make 2 over 2 trades, obviously you can see it returns an average R of 1. So every 2 trades, you're averaging 1 R. So if we put 100 trades in there, risk 1 to make 2 or more, for 100 trades, I'll put it on this line here, you can see that pays out 50R, or 50% of portfolio, I will say. So if you can repeat that process 100 times on a risk 1 to make 2 multiple, sounds easy, doesn't it? In reality, it doesn't really work that way. In reality, if you risk 1 to make 2 or more, your winners, as soon as you add a trailing method and a little bit of risk management to sort of trail towards those winners, to free up heat to take more trades under the heat rules, then you find that some trades will go to sleep and they'll soak up heat on the account. You might close them to open new ones, and you'll probably find risking 1 to make 4 could average 2. You're probably half what you expect, but still, that would be fantastic, wouldn't it? It's if you was basically coming out with half of that, 25% for a year, well, that's where you want to be, isn't it? But when it comes to the real market of riding trends, or holding for bigger winners, what you've got to remember is the market swings from easy money to grinding it out, sort of treading water, and anything in between. So what do I mean by that? The risk 1 to make 2 or more, it's going to be fantastically easy in a fantastic market where it's the market is you know, lifting all boats. You know, it's just the easy money market. The trouble with the easy money market is everyone thinks they know when it's going to happen, and the stocks move before the market. By the time you realise it's an easy money market, the easy money market is usually in the rear view mirror, and you know, then it reverts to a grindy market, or the worst scenario is like a bear leg in a market. So in reality, the market swings from you know, you can be right 60% of the time down to, you know, 40%. In really tough markets, you're going to be down here, aren't you? You know, you're just banging your head against the wall, losing money hand over fist. And in fantastic markets, it's as if you've got the key to the kingdom. That is the reality. It's going to swing between the two. So over time, risk one to make two or more sounds fantastically. I mean, that's all you've got to do. But to do it over time, you've got to have bigger winners, haven't you? So basically, let me just show you how I run my trend portfolio. This is it this morning. I've just screen grabbed this. Total trades. This is open and closed. My winners are 7.5 times bigger than my losers. In the open portfolio, they're 32.6 times bigger. And I'll just do a little bit more. Oh, and you can see that I'm right. Basically on everything, I'm right about half the time there. The open portfolio is right 65% of the time nearly. That's on open trades. So let me just bring my account dashboard up. So I'm right on all open trades 65% of the time, and I have 57 open R on the table. Now open R is not all the same in pound terms, because compounding winners, new trades get taken at a bigger R multiple. So you've got to remember that going back to the £1,000, you know, 100,000 account, 1% is 1,000. When you compound some winners, well, you're going to be trading 1,100. You know, it's or bigger or small. You know, it's going to move up and down. So these are from initial risk, you know, what that risk was when I took the trade. So it's not going to be exact, but it's going to be very close. So at the moment, 65% open trades are right, and you know, I've got 57 R on the table, and we'll just go back to this, and I think I've got 18 trades running. So I'm right 65% of the time. I only go up to 60% on here for obvious reasons. You know, we try and show the sensible area. And what were they? My winners were 6 point whatever times. And because some of those winners are on the old compounded account and some are on the new compounded rate, this is where I am, isn't it? I'm around here. Sorry, I'm around here. 60% right, you know, 6 times the multiples. It's kind of just pulling it into line a bit with just the risk being consistent all the way through. So, you know, that is a fantastic market. That's where you should be in a good market. It's not. It's a grindy market at the moment. You know, it's been a fantastic market. I'm riding some big winners. You know, I've compounded some big winners. So next we're gonna talk about distribution of R. So what is distribution of R? As the trades get closed, the distribution is basically you're going to have a lot of scratch trades. So you might have trades. You might have trades. What the outliers are going to be at this end. You're going to have some big outliers. Over 100 trades, let's say you get 5 big outliers, and you get 10 spread out in the sort of multi-R area, and then you're probably going to get 55% of the rest of the trades are going to be scratch. Small winners, small losers, you know, all around here. So we'll say 60% scratch. I know mine's running at like 50% scratched with some some quite good trends running up here. But we'll just say 60% scratch. We'll say 5% outliers above, say, 9R plus, and 35%, meaningful winners. That is going to be normal, the distribution of those 100 trades. I'll put 100 in. You're going to get basically some of the scratch trades were pretty okay winners, but they came back down and stopped me out, and they end up small winners or scratch. Say it was 4R last week and it came out with a profit warning and stops me out at 1R. It's a scratch trade. So you're going to get ones what visit this area but stop you out down here. You're going to get ones what visit the outlier area and stop you down in, the reality is, to get to this area, you've got to deal with all that flip-floppery. You've got to deal with not knowing which the big winner is going to be in the portfolio. You've got to, it's just what you've got to grind out, those small winners, small losers. And that is how it's going to distribute over time. Put them in a demo account. Trial a load of trades, see how it works out. It will distribute that way. Occasional outliers. If you've got a good methodology, a handful of reasonable winners and a lot of scratch trades. So, when the market's horrible and you can only be right 35-40% of the time, you're going to be basically knocking out some scratch and full losers, scratch trades. Losers are scratch trades. -1, +1, -1, +1, +2. It's in the scratch area. Occasional slippage, -2. -5 maybe. Profit warning. You've got to remember these big winners have to pay for the occasional absolute, rug pull in a stock where it gaps down 50%. So, the distribution of R is something you should get to know. It is what it is. There is no way of avoiding it. If you trade long enough, and shout out to Nick Raj, next 100 trades, he always says, that's what it's about. It's not about the trade it's not about that stock what you had a lot of hopes and dreams for and you're watching it on an intraday chart because it's bumbling around there. It's not about that stock. It doesn't matter. It's about the next 100 stocks. You don't know which that next winner is going to be. Nobody does. I know everyone thinks they know. Nobody does. So the reality is, good markets, this is where a lot of people do business, in the screaming I'm right or wrong area. It's all about being right or wrong, and it's quite easy to be right. If you're just trading towards, you've got a wide stop and you're trading towards a 1R target, it's a 1-to-1 bet, and the pressure on it, the money is made by being right more than 50% of the time. That is basically what happens there. So, if you're right basically 1 and you're wrong 1, your reward to risk is 1-to-1. Over 100 trades, you're going to put 20% on the account if you're right 60% of the time. The reality is, the market swings where you can be right 65% of the time, and then it will swing back down here, and then you're going to be wrong 65% of the time. That is the reality of it. So you don't want to be stuck in this area where you've got pressure on being right. What about this area where I'm in this area at the moment. I only have to be right 15% of the time at the moment on the averages my account's running at. It is, whatever. When the market gets tough, that will change. I'm showing you, and I know the market's a bit grindy at the moment, but don't get me wrong, this is pretty normal action. You've got to be able to grind out. I'm going to move on to that, actually. So when the market is terrible, and you're really struggling, if you haven't got a method what can get the big winners, you're going to be really struggling in the markets, aren't you, down at this end. And because repeating 100 trades when you write 1-to-1, when your reward to risk is 1-to-1, and the market's only letting you be right 40% of the time, you're going to be down 20% on the year. If the market's only letting you be right 35% of the time, you're going to be down 30% on a year. Now, you've got to get out of that area. It's not the place to do business. Pressure on being right. It's about how right you are when you are right. R multiples, And when you come to the markets, usually you have a little bit of luck. You confuse luck for skill. You make a little bit of money, then the market pulls the rug and goes, ha, that's mine, and it takes it back off you. And then those who make it through that phase have to start building something what makes money. And basically, what gets you from being plugging leaks in the account to break even, it might not be what gets you from break even to profitability. What do I mean by that? Well, bad habits can actually create a break. Have you ever sold your best idea to pay for losers? We've all done it. You've got a fantastic idea and you've got some losers on the table, and you think, oh, right, the market's pulling in. I'm going to sell this winner. I'm going to bank 5R on this, and I've got, these 3 trades what are, down at my stop levels. They're minus 3R. It kind of pays for those, and I can give them a bit of room, and then those 3 stocks fade lower, and you end up being down 1R by the time you actually blink. And so bad habits, selling winners to pay for losers, and maybe add to losers, those bad habits might get you to break even over and over again, selling your best ideas over and over again, doing, scaling out of your best ideas and adding to your worst ideas. In the short term, in a good market where you can be right more than half the time, it might create the effect of a break-even methodology. But as soon as the market has a little bit of a grind or goes into a bear leg, all of a sudden you're down in that hole again. So what gets you to break even? I've just noted a few of those things what can do that. They might not get you to profitability, because when the market is good, you should be achieving you should be riding some big trends. Now, remember coming out of the I talked about it last night in the screening session. When the market was coming off the lows, 90% of people thought the market, it was a dead cat bounce. In my head, the little earworm was in my head as well, and I thought the same thing, but I stepped up. I know what my job is to make money, is to buy the best growth stocks as they emerge from the early bases, as the market lifts the pressure off, the pressure eases off the down leg, and they start to pop and break out. And that was my job, even though the little voice in my head was going, I think this is probably a dead cat bounce. We're probably going to fade, or at least whip up and down like 2011, in a wild, volatile sort of way. Even though in my head the little earworm was telling me that, I knew my job, what makes the money, was to take those setups and limit my heat and, add more as the market let me add to these trades and freed up more heat. And guess what? I always say, I don't trade on what I think. I trade on what makes the money. So what makes the money is knowing exactly what makes the money and how the market can sort of affect, being right, and how right you are when you are right. And when the market's grindy, you are the duck flapping it calm on the surface, flapping its feet like mad just to stay afloat under the pond, under the water. And then when the market is terrible, you're going to go down into drawdown. And for me, the index trend model will unwind my positions orderly and very stress free. So, no predictions. Next 100 trades. Shout out to Nick Radge on that, which I've kind of stolen, haven't I? But yeah, this morning's radar is about came to you from the letter R multiples.